Welcome back to the Longacre's Finance channel. It's time to crunch the numbers and see which Dividend Aristocrats look the most attractive for the month of December. I use two very simple methods to choose the best Dividend Aristocrats each month, and a third method that is a blend of the first two. During the past 3 months, one of these strategies has beaten NOBL by 4.89%. Another strategy is 2.08% ahead of NOBL, and the third is losing slightly, but that was somewhat expected. The strategy that is underperforming NOBL is expected to be a long-term play, providing expected alpha down the road. Let me explain how each strategy works, share with you the selections for December, and offer a quick recap of the results thus far. But before we get going, if you enjoyed the video, please give it a thumbs up and subscribe to the channel. Strategy 1 is a pure undervaluation play, where I seek the 10 most potentially undervalued Dividend Aristocrats based on dividend yield theory. This theory compares the current dividend yield to the trailing dividend yield. If the current yield is larger than the trailing yield, the stock is potentially undervalued, and vice versa. I am comparing the self-computed current dividend yield to the 4-year trailing dividend yield provided on Seeking Alpha. The objective here is to target the best bargains from amongst the Dividend Aristocrats, and the expectation is that when these companies recover, we will benefit from the return to fair valuation. It may take a few months or even years for valuations to return to long-term trailing averages, and there is no guarantee that they will. Therefore, I expect this strategy to reward us with alpha in the future, and possibly underperform NOBL in the short term. The ideal way to implement any dividend investing strategy is with a buy and hold approach. Basically, you keep purchasing shares of companies with the intention of never selling these positions. Let's see which 10 Dividend Aristocrats are the most undervalued right now, and will be added to this strategy in December. In alphabetical order we have Aflac, that is potentially 17% undervalued right now, Amcor, that is potentially 20% undervalued, Atmos Energy, that is potentially 22% undervalued, Becton Dickinson and Company, that is potentially 9% undervalued, Cardinal Health, that is potentially 9% undervalued, Clorox, that is potentially 11% undervalued, Hormel, that is potentially 14% undervalued, IBM, that is potentially 15% undervalued, AT&T, that is potentially 23% undervalued, and Walgreens, that is potentially 17% undervalued. Of these 10, Aflac, Becton Dickinson, and IBM are appearing on the top 10 most undervalued list for the first time, and they replace ComEd, McCormick, and VF Corporation from the prior month, which are all having positive returns during November thus far, which in turn brings these companies closer to fair value, and makes them less appealing options in terms of valuation. The most undervalued strategy is up 1.37% between August and October, which is 0.42% less than NOBL. As I mentioned earlier, this strategy is expected to start off rather slow, and the buy and hold approach for the strategy is also trailing NOBL thus far, with a 1.01% return for the last 3 full months. It trails NOBL by 0.78%. I think it might take a year or two before we see whether the strategy for selecting Dividend Aristocrats has any merit. That is a rather long time to wait, and there is a possibility that this approach may not pan out. Let's take a quick look at how the 10 most undervalued stocks for November are doing thus far. The preliminary returns are through November 23rd, and they may change slightly with a few more trading days left in the month. NOBL is up 2.15% thus far for the month of November, and the 10 most undervalued aristocrats are up 1.85%, so they are trailing NOBL by 0.3%. Another potential month of underperformance, but this is in a wide gap that may shrink over the coming days. The individual preliminary returns for November are a 5.82% gain from McCormick, a 4.73% gain from ComEd, a 3.19% gain from Clorox, a 3.18% gain from Atmos Energy, a 2.53% gain from Cardinal Health, a 2.18% gain from VF Corporation, a 2.04% gain from Hormel, a 0.57% loss from Walgreens, a 1.19% loss from AT&T, and a 3.4% loss from Amcor. The buy and hold portfolio will also benefit from the returns of prior undervalued stocks that have since fallen out of the top 10 list. They are AbbVie, Ben Franklin, Chevron, General Dynamics, 3M, and Exxon. You'll have to wait till next month's update to find out the final results for November. Now let's move on to strategy number 2, which is the top 10 highest expected growth Dividend Aristocrats. In this strategy, I am looking for the Dividend Aristocrats that are poised to offer the best return going forward. The return forecast is based on forecasted earnings growth and a return to fair valuation. This computation is an assumption of where the stock may go in the near future, factoring in the current valuation as a starting point. Historically, companies with high earnings growth rates have also experienced high total returns. My goal is to leverage this correlation and use earnings forecast as a gauge to selecting the Dividend Aristocrats that should have the best earnings growth rates in the future. Let's take a look at the top 10 aristocrats for December, along with their forecasted rates of return. In alphabetical order we have Caterpillar with a 29.63% rate of return, Chubb with a 23.86% rate of return, Ecolab with a 14.82% rate of return, IBM with a 19.69% rate of return, Linde plc with a 15.87% rate of return, Lowe's with a 14.08% rate of return, McDonald's with a 19.99% rate of return, Nucor with a 19.16% rate of return, Cisco with a 54.99% rate of return, and VF Corporation with a 47.34% rate of return. I don't actually believe these companies will hit these rates of return, but I do believe these 10 aristocrats should offer a better return than NOBL over the next 5 years. One of these aristocrats is making its first appearance under the strategy, and that company is Ecolab. They are replacing Illinois Toolworks from the prior month. Illinois Toolworks is having an excellent return in November, as I will go over later, and as such, they no longer present one of the best future return rates going forward. The goal of this strategy is to add money to the stocks that present the best future opportunity every month. It's natural that there will be turnover in the top 10 list, because when companies reward us with strong returns, they will likely no longer present the best opportunity going forward. This strategy has a 3-month return of 6.68%, that is 4.89% better than NOBL. It is thus far the best performing strategy, far outpacing the most undervalued strategy. The buy and hold portfolio is performing a little worse, with a 6.42% return during the last 3 months, which is still 4.63% better than NOBL. The preliminary results for November are promising for the strategy, as right now it is up 2.41%, which is 0.25% better than NOBL. Let me read out the individual returns for the November list. The best performer is Lowe's with a 7.92% gain, followed by Illinois Toolworks with a 6.19% gain, Nucor with a 5.32% gain, McDonald's with a 4.24% gain, Linde plc with a 2.47% gain, Caterpillar with a 2.21% gain, VF Corporation with a 2.18% gain, Cisco with a 1.25% loss, Chubb with a 2.45% loss, and IBM with a 2.77% loss. It's very hard to pick only winners each month, and that is certainly not my expectation. But I am happy to see that collectively the top 10 picks are doing better than NOBL. The buy and hold portfolio for this strategy will also benefit from 3 more Dividend Aristocrats that have appeared in the top 10 list previously. These companies are Albemarle, People's United, and Stanley Black & Decker. Finally, let's move on to strategy number 3, which is a blend of the first 2 strategies. Here I am looking for the top 10 aristocrats with the highest expected returns, but only amongst the potentially undervalued list. So I am shooting for the best future return, but I'd like to only buy stocks that are trading for a bargain right now. There are 23 potentially undervalued aristocrats right now for us to choose from, and the 10 undervalued aristocrats with the highest expected returns are Amcor, that is about 20% undervalued and expected to return about 10.5% per year, Atmos Energy, that is about 22% undervalued and expected to return about 12% per year, Becton Dickinson, that is about 9% undervalued and expected to return about 12% per year, Cardinal Health, that is about 9% undervalued and expected to return about 9% per year, General Dynamics, that is about 3% undervalued and expected to return about 9% per year, Hormel, that is about 14% undervalued and expected to return about 10.5% per year, IBM, that is about 15% undervalued and expected to return about 19.5% per year, Medtronic, that is about 7% undervalued and expected to return about 13% per year, 3M, that is about 6.5% undervalued and expected to return about 9% per year, and Walgreens, that is about 17% undervalued and expected to return about 9% per year. For December, General Dynamics and Walgreens make a return to the top 10 list, and Medtronic is making its first appearance. These 3 aristocrats replace A.O. Smith, Cisco, and VF Corporation from the prior month's top 10 list. Over the last 3 months, the blended strategy has a return of 3.87%. That is 2.08% better than NOBL. The buy and hold portfolio for this strategy is doing much worse, with only a 1.8% return. That is 0.01% better than NOBL. The reason for this large difference between the buy and hold portfolio and the monthly top 10 list is due to October. The monthly top 10 list in October had a solid return of 4.76%. That was driven by 3 new additions to the list that month. These 3 stocks impacted the buy and hold portfolio much less, since they were added to the portfolio during the month of October. And many of the older positions that did not perform as well last month represent a larger allocation of the buy and hold portfolio. This is certainly something that can happen in the future. And conversely, we can also experience the opposite result as well, where the buy and hold portfolio will outperform the monthly top 10 list. Thus far in November, the top 10 blended strategy stocks are up 1.82%, which is 0.33% worse than NOBL. This isn't a wide margin, and there are still a few days for the blended aristocrats to win the month. The individual returns for the November selections are a 13.41% gain from A.O. Smith, a 3.18% gain from Atmos Energy, a 2.68% gain from Cardinal Health, a 2.47% gain from Becton Dickinson, a 2.18% gain from VF Corporation, a 2.04% gain from Hormel, a 0.31% loss from 3M, a 1.25% loss from Cisco, a 2.77% loss from IBM, and a 3.4% loss from Amcor. So thus far, strategy number 2, which seeks the highest expected returns, appears to be performing the best. I think each of these 3 strategies should offer alpha over NOBL in the long term. I intend to continue tracking how these strategies perform over the next few years. Also right now, the buy and hold portfolios for all 3 strategies are underperforming the monthly top 10 lists. The gap isn't wide except for the blended strategy. Please keep in mind that these strategies are based on assumptions, and I am not recommending them to anyone. You should decide what the best investing strategy is for you. I hope you enjoy the content. Thank you for watching and see you next time.